morning. I hope you're doing well. Today is the Thursday, 3rd of June, and we are on the day of the weekly expiry. All of my orders have been placed as an aftermarket order, and I had some time free, and I thought that today I would touch base on the topic of money management. This topic is quite complex because it is very mathematical, with the idea being that we are trying to determine the optimal bet size to maximize the portfolio while keeping the risk of ruin within checks. Uh, and we do this by analysis of data, our own data. Very often you will see that traders make projections based on back-tested simulated reports. That projection is useful for them in order to determine the initial position sizing that they need to take. However, once you cross a certain number of years in your own trading, you do not need those reports, and real-time market data will be available to you from your own trading. And the question now is, how do we assess this data and what are we trying to assess from this data? Let's just get to the video, the content of it. So first step is that you would want to go to your console on Zerodha, and you want to select your entire historic range. So I have, for example, you can see I have selected from 2017 April to 2021 June. The reason for this period of selection is because Zerodha does not have data from prior to this period. So you can only get till 2017 and till date. So while we are still getting it, I recommend that you download all of your data, and it does not matter how good or how bad it is. The idea is to assess it to make continuous improvements in the future. So once you have selected the segment, so my segment of interest here is the FNO segment, and you have selected the time period, you will basically end up getting a list of all of the trades that you have taken from the given period. So you can see that this is right up till 43. And within this within this list, what you basically get is the name of the contract that you traded, the quantity that you traded, your average buy price, average sell price, and your net realized PNL. This row as is becomes very critical for us, the symbol, buy value, etc. And what we want to do is we want to replicate. So you can either just download this list as an Excel, or you can copy this content in simply using your cursor and paste it into an Excel. And when you do that, you will get an Excel sheet that looks like this. So here we have it from April 2017, and if we keep scrolling right up till okay, a lot of rows, this is my historic data within the stock future segment, within the futures segment. Options are not included in this because options have a totally different strategy. In this Excel sheet, I have grouped only those trades which are of a particular system. Likewise, you will not see equities because equities is a totally different system. Now, when I have this Excel sheet, so you will notice that what I have the symbol here, I have the quantity here, the buy average, and of course the buy value, sell average and sell value, and the net realized PNL. This information, that is from what I have from column C to column I, is readily available here. Symbol till net realized PNL is readily available here. The percentage change in PNL is also available, and we can also calculate it. So here we can see we are getting this number as 26.41%, 36%. This can also obviously be calculated because you're only calculating a change in price between your buying and selling value. This will tell us the total PNL that we have. So which means that in April 2017, my first stock future trade in Zerodha systems, as per records, it could have been even earlier, resulted in a loss of 23,000. So my total PNL is 23,960 loss. My second stock future trade resulted in a loss of 14,940. Consequently, this value is a sum of this and this, which is represented by sum of I3 and K2. This is I3, this is K2. The reason why I'm showing this to you is so that you can replicate these formulas as is and use it in your own Excel sheet. And if you do that, what happens is that you and I have a common point to touch base on, which means that if our templates are similar, it becomes very easy for us to communicate further. Now, once you have done all of this, the next step in terms of identifying money management is basically, I'll just direct you to a slide now. What we want to do is we want to calculate first the total number of trades that we have taken. Since June series is ongoing, I will not exclude the trades that we have taken in June series, but the total number of trades that I have taken actually are 567. That is 567 contracts. Now, once you have, so which is simply a count function, you just have to count how many trades you have taken, which is, you just scroll and you can check, or you can use a count function. Once you have done that, once you have calculated the total number of trades, I also want to add that there is something known as a run status that I have added, which means that this is simple loss, 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 profit, profit, profit. How does it determine this? The formula is simple. If J2, where J is the realized PNL, is greater than 0, then it is a profit, else it is a loss. So since this is minus, it's less than 0, therefore it is loss. So only if it is greater than 0 is there a profit. If it is equal to 0, we consider it as a loss. Now, once you have your total number of trades, then on this side we want to have what is known as the working. That is, we are doing our working. In this working, the first step is to count our profits. That is, count how often have we actually hit profits in this particular instrument. So you will see that I have deployed a count function here, which means count if. I want to count if the rows between L2 to L568, which means my run status, is in profit. So this number of 228 is just giving me the number of times I have been profitable in this entire selection. Similarly, once you have done the count of profit, you can easily do the count of loss by using the same formula, count if between the range, and in these in these inverted commas you want a loss, and what you will have here is 339. Once you have your absolute number of winning trades and absolute number of losing trades, what you start getting is your win rate. So here I have written W, but I will just emphasize it with a win rate. So a win rate is nothing but the number of times you have been profitable upon total number of trades, and you want it in a form of a percentage. Similarly, we also get what is known as a loss rate. How often, what is our percentage of losses in a particular trade, and you can see that it is either 1 minus this value, or we are getting tentatively 60%. So what we are getting here is from my data, in the futures segment, we are seeing for dated 2017 till 2021, we are seeing an accuracy of 40% or a loss rate of 60%. Next, once we know what is our win rate and loss rate, we want to calculate what is our average profit. So an average profit is simple. We want to average if the realized sum is profitable, which means only, for example, this entire row has been selected for the purpose of calculation. But for example, you will see I have a loss here, loss here, loss here, loss here. When I select these 4 losses, you are getting an average loss of 15,363. If I select furthermore 4 losses, my loss ratio is now at 11. My average loss is 11,501, which is nothing but the sum of all losses divided by the number of iterations. So we get an average profit from this set at 62,838 rupees, which means every time I take a trade, and if it is a profitable one, then 62,000 rupees is a fairly average profit. Similarly, every time I take a hit, I lose 26,766, and the formula is the same. I want to average if the selection is trading less than or equal to 0. So If that is happening, I will consider it a loss and my average loss is as shown. Once you have your average loss, you then get what is known as an R multiple or a risk reward ratio. So I'll just write risk to reward. So this is a risk reward ratio, and which is nothing but profits divided by your so it's a reward to risk, but your profits divided by your, so I'll just write this here, reward to risk, because we have the reward in the numerator and the risk in the denominator. So this value is nothing but the profit divided by the loss, and you will notice that I have multiplied this by -1 because we have this as a negative number here. So we are now getting an average RR of 2.35. Now we have with this a very basic set of data that will help us in taking decisions related to our position sizing. Now, so here for example, now just putting, because we need to give a reference, we know that I have taken approximately 567 trades. We know that 228 of them have been profitable. We also know that 339 of them have been loss making. We know that our average profitable trade is 62,838. Our average losing trade is minus 26,766. Our average risk to reward ratio is 2.35, and once we have these details we can actually calculate our first term, which is known as an expectancy ratio, where this term was actually popularized or maybe developed by Van Tharp, and he has written a lot of literature on this subject. And what the expectancy ratio is saying is that what is the average money that you will make every time you take a trade. All right, and remember that it doesn't matter if the value is +1 or +5 or +5,000. It simply doesn't matter. What we want is we want to definitely have a positive number here. If we have a positive number here, you must understand that you are trading a system with a positive expectancy. And if you're trading a system with positive expectancy, you have to repeat the system. Repeat it many times. That is, you have to give it maximum exposure. So I'll just repeat the maximum exposure. So once you know that you have a positive expectancy system, you want to give it maximum exposure. And in the process of giving maximum exposure, you are inevitably going to maximize risk because you want to give it maximum exposure. And when it is that you want to give it maximum exposure and consequently there is a maximization of risk, we want to calculate what is the optimal amount of betting size that I can do. All right, now so so with this basically I have mentioned the expectancy value. Expectancy, okay, I'll just show you if we all right, so this is some Samurai Trading Academy, but I have actually read this in a book. But since I was just Googling for the purpose of this video, we can see that the expectancy is probability of win into average win minus probability of loss into average loss, which in our case, we know our probability of win, we know our average win, we know our probability of loss, we know our average loss, and consequently we get an expectancy value of some number which is positive. And when that number is positive, we know that we have to maximize or repeat this particular trading system. Now the question then becomes how much? And this answer, I will get to the other factors like Z score, Kelly criteria, optimal F, risk of ruin, etc. But this is actually determined by what is the probability of consecutive losses that you can get. So just remember, let us assume you have 100 rupees and let us assume you have a 90% accuracy. So in a system of 90% accuracy, it is fairly reasonable to assume that you will face at least 2 consecutive losses in your history of trading. Given that with a 90% accurate system, you are likely to face, very likely to face two consecutive losses in a sequence of 100 trades or 1000 trades. You can never risk more than 50% of your total risk capital, because if you do that and you hit two consecutive losses, whether it is the first loss or whether it is the 150th and the 151st trade, if you happen to risk half your equity in both those cases, like the same amount in that value, you will most likely not be able to continue trading. So therefore, this actually is exceptionally critical for us to understand what is the probability of consecutive losses given that we know our accuracy of 40%. So for this purpose, I want to show you a table here. Right? I think this is maximized too much. This resolution is a little weak. Here, I hope you can see this. So basically what this is saying is probability of consecutive losing trades in a sequence of 100 trades. All right, probability of consecutive X losing trades in a sequence of 100 trades if your win rate is in these ratios. Yeah, which means that if you have a win rate of only 5%, it is a certain event that you are going to have 10 consecutive losses. Likewise, if your win ratio is of 95%, it is an impossibility for you to have 10 consecutive losses. In fact, it is impossible for you to even have 4 consecutive losses. And like we said, we use the example of 90% accuracy. So two consecutive losses also has only a 63% probability, but 5 consecutive losses almost certainly never happens with this kind of a system. So these are obviously highly accurate systems, and you can risk a lot more if you have a highly accurate system. But what about people like us whose trading ranges fall between the 30 to 60% category? Now, uh, this 30 to 60%. Now, why am I saying 30 to 60% while we have also calculated 40%? The reason is because this is capturing my data from 2017 and we are right now in 2021. So there is 4 full years of trading that has happened in between. But the data reflects my trading acumen, which was 4 years ago, which was not bad even back then, but it was definitely not as complete as it has been perhaps in the last 2 years since I got into managing other people's money, and these statistical nuances had a lot more meaning to me than when I was doing it individually on my own account. Nonetheless, so now the question basically is that given that we have a 30 to 60% win rate, uh, a 60% win rate is something, if I hit, I make a lot of money. So I would say that when I suffer, I normally get in the 30 to 25% zone. But it is reasonable to assume that, of course, like we have just seen, that my average futures trading happens between 40. If it is weak, it will happen at 35. And if it becomes very strong, it will happen at 45. So I am somewhere here. And when you see between 35 to 45%, you will see that even at 45%, there is a 21% chance that in a set of 100 trades, I am going to lose 10 consecutive times. Now, if there is a 21% chance that I can lose 10 consecutive times in a set of 100 trades, it is reasonably safe to put a 5% chance to give me a loss of 20 consecutive trades in a set of 100, right? And therefore, the question now becomes, what should be my trade, what should be the optimal percentage that I risk per unit trade, right? Given that I know that I am averaging between uh, um, 35 to 45%, so I and my clients within the system that uses this particular future setup should almost be certain that we are going to experience 10 consecutive losses, which is right here. And given that losing 10 consecutive times is a near certain event. Remember, when we are dealing with law of large numbers, law of large number means that you're going to repeat something hundreds of thousands of times. If anything has a probability of more than 1%, you can be almost certain it is going to happen to you. So what we want to do is we want to ensure that we don't get caught in what we call as a black swan, and 1% is not a black swan. We want it to be actually dipping below 1% even. So I mean, say for example here we have like with a system with 65% accuracy has a 1% chance of having 9 losing trades and a 0% chance of losing 10 trades. We can be sure only here that if I hit a career average of 65%, I will never lose 10 consecutive trades, and consequently I can bet as high as 10% of the total risk capital. Now, what is the total risk capital? Let us assume that my trading capital is say 50 lakh, is like, give it a say 100 rupees. And if my trading capital is 100 rupees, it is not necessary that I intend to risk the entire 100 rupees. In fact, if my trading capital is 100 rupees, I don't even want to risk 35 rupees. So I want to build a system which factors in which I consider my risk of ruin as 35 rupees out of 100, which means that I don't have to wait for my account to become zero. I will quit trading by the time I hit that kind of a loss. So the question now becomes, what is the optimal bet size? And for this particular aspect, we have to review certain concepts called as Z score, Kelly criteria, optimal F, and risk of ruin. Now, uh, each of these concepts, I can give you like I can directly tell you what my Z score is, Kelly criteria is, etc. But for each of these concepts, the if you want to understand the concept, you will have to spend some time beforehand with that particularly when we are dealing with Z score and optimal F. Risk of ruin also, yes, but optimal F from Ralph Wins is a very tricky formula, and it takes some doing to be able to I beg your pardon, to be able to identify the correct percentage amount that you should be risking per trade. So nonetheless, I think for today we will. I mean, we will just leave it at this. I'll not get into these details because actually it can take a couple of hours. I don't know what I was thinking when I even wrote it here. I think the key takeaway of our today's video should be that step one, go to Zerodha or whatever broker you have, download your entire trading history, calculate your probability of winners, probability of losers, average winners, average losers, and determine if your expectancy value is positive or not. If your expectancy value is negative, which means that suppose I give my win rate as, I don't know, just give it a random number like a coin toss, I give it a 50% win rate and a 50% lose rate. I'll just copy, oh, sorry. And I give it a 50% lose rate, and I give my average winner as 1, and I give my average loser as 1. So I get my risk reward as 1. Now the question is, what happens when I replicate? Got this in percentage. Shouldn't have got this in percentage. Okay, and so EV is giving a positive value, though it should not be giving a positive value, because I can be reasonably sure that this is not supposed to come out to be positive, or uh, so I mean I'm too late into the recording to be able to edit this bit. But yeah, my point basically being that actually what I wanted to say is that a fair coin toss with 1:1 risk reward is actually a losing system. I gave it against the expectancy value, but the better, or actually accurate would have been done through Kelly's criteria. I just missed the example, so for the sake of argument, I'll delete it. But the point basically being that I am showing 40% win rate. You might be showing 20%, or you might be showing 80% win rate. I am showing an average risk reward in the future segment as 2.35 is to 1. You might show 3 is to 1, someone might show 10 is to 1. The optimal bet size for each one of us is going to be different, and the optimal securities that work within our system is going to be different. As you can see, I have traded literally every security that can be traded in the market within the segment, simply because I'm also curious. And yeah, and these are the futures records. And yes, of course, like, we can always see that when you have, so you can see here that in a transaction in which we booked 4,58,000 from SBI, you can see our brokerage charges is rupees 100. In a transaction of Hindalco at 3,83,000, our brokerage is 69. So what it basically goes to show is that when we are getting 26%, 36%, etc. moves in the future segment, we are taking one entry, we are taking one exit. Very rarely are we squaring of the positions in between, like I had to do if there is a margin issue or some constraint like that. But once, I mean, your records are going to govern the decisions that you have to take afterwards, and it is very specific to your individual records. I can, using this picture, tell you with reasonable certainty that my options trade, option writing particularly, comes between 65 to 80%. Consequently, I can be quite sure that I'm never going to have a 10 losing streak loss. Given that I am so confident that I'm not going to have 10 losing streaks of losses, I can now determine what is the optimal betting that I can do in order to maximize my returns. Given that if I'm trading, for example, a Nifty or a Bank Nifty option, I know the market will circuit at 5% lower value, which means that when I'm writing an option, let us say I write an option for a premium of 100 points and the market opens lower by 700 points. In that case, obviously I would have chosen a deep OTM option. I stand to lose around 3 to 500 points, and the worst case could be somewhere around 700, 800 points depending on how much gamma is triggered in the option. So given that my worst case scenario is not more than 50,000 rupees, now that the lot size is now from 75, now that it has become 50,000, so I mean 700 points on a lot of 50 is 35,000 rupees. So given that my worst case scenario comes somewhere between 30 to 50,000 rupees, I am fairly comfortable in determining how much money I need to have in my account so that I can absorb that one, two, or three worst case scenarios. So, I mean, three consecutive gaps against you. It's rare. Three consecutive circuit gaps against you. I mean, if it's a 100, 200 point gap, we sit through that every day. The problem is something like a Brexit or a demonetization where you might have shorted a call and the might have shorted a put and the market opens at an obscenely different range. What do we do then? So this information actually helps us decide what to do then. So it is not only our assessment of the individual stock, but it is seeing the whole thing in totality and what I am experiencing throughout. So you will see how a person evolves from the data. For example, if you look at my trading from April 2017, just look at this. There is, I go through a patch of 12 consecutive losses before I hit my first gain, which is of 2,775 rupees. And the biggest gainer is of 41,000 rupees, and it's like very low. After those 12 losses and almost negligible gains, I go through another set of 11 losses before I hit my another significant gain, and that is of 1,000 rupee. You can see that I'm already down here by minus 2 lakh. Subsequently, after hitting this profit, I now streak on profits, which means that I hit 7 consecutive profits. And in these 7 consecutive profits, my biggest trade is at 66,000. And okay, I'm coming back now from minus 2.15 lakhs, I'm coming to 90,000 rupees. So when you look, so while you are seeing this as simple P&L, I know these trades exactly what I was thinking, of why I was doing what I was doing, and how I could have done it better. For example, we are just brushing. You will see Ajanta Pharma, Biocon, Lupin, Glenmark, Oro Pharma, Sun Pharma. What is common in all of them? They are all pharma, which means that I chose a sector and I just plunged all in into that sector. And I'm not all in, but I went quite deep into that sector. So this, I don't want to get into the details of this right now, but this review is very critical for your development as a trader. And in fact, this is more important than knowing that okay, the oscillator is oversold or overbought. This actually really takes care of you, because the minute your trading records are showing you a negative EV, you need to work on something. Either you need to get a greater accuracy, or you need to go the longer distance in the market. You have to choose, and you have to make a conscious decision. And when you are profitable, like when you hit a positive EV value, again you have to choose whether I want to go for still longer distances, or whether I want to trade with tighter stop losses. I need to do something. Either I need to maximize my profit, minimize my average loss, or I need to maximize the win rate or minimize loss rate. Each of these approach gives, you could say, birth to various trading strategies which have default inbuilt accuracy in them, which means that if I want a highly accurate system, I will simply get into option writing. But if I want a system that is designed to catch delta, I have to go futures. So sum and substance is that we will I hope that this basic video would have given you some thought about the math that gets into trading. I can show you the Excel sheets, but they're just, I mean, it's just going to bore you because it is not specific to your trading. And generally, um, um, my team and I have received several requests that are asking us to teach them how to trade. But I can only say one thing: you have to decide, do you want to learn how to trade, or do you simply want money? If you simply want money, then just choose the trader. But if you want to learn how to trade, it is not what you're thinking. You have to do the math and you have to do the assessment, and hopefully, with that, we can take much better decisions. Anyways, I'll get ready for the day ahead, and I wish you all a good day trade session in the expiry today. Have a good day. Take care.